In this presentation, we will continue on with our corporation comprehensive problem recording the transaction for a vendor payment. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're going to have the information on the left, enter that into our general journal, post that to the general ledger, and then create the trial balance from it. Paid vendor for supply purchased on 1/5 for $5,000. First question I would ask is cash affected. We're going to say, yeah, all we need to see there is paid, and that would generally mean we paid cash. Cash has a debit balance. We're going to make it go down, doing the opposite thing to it, which in this case is a credit. So that's where I would start. I'd start putting the credit down. Notice I put it on the bottom here and putting that first in the credit column. I'm going to build not in terms of debits first, top to bottom, left to right, but in terms of what makes most sense. And cash is the easiest thing to think about first. It's easiest to know which way it's going, easiest to record the debit and credit. Then we know that we're going to debit something, so I could think, okay, there's going to be a debit here for $5,000. What account will it go to? So in this case, we paid vendor for supplies purchased, but the purchase happened on January 5th. So what's happening here, and again, in real life, we would know this. We would be paying off a bill for something that happened in the past. In real life, we would know that in a book problem, it's a little bit more difficult because we'd have to say, okay, what does this thing mean? What does it mean? What's actually happening? What are they trying to indicate what would happen in practice? And what this is saying is that we paid the vendor for supplies that was purchased in the past. It might say as simply as we paid vendors on account, or we paid vendors on credit, meaning we're paying off kind of like a credit card, paying off what is owed for something that was purchased in the past. Therefore, even though we're buying supplies, we're not going to put the debit to supplies or to supplies expense because we already recorded the supplies. We recorded it at the point of payment. And you can think of it kind of like we paid with a credit card. Now we're paying off kind of like the credit card type of idea, the liability, what is owed. And so we have accounts payable. So accounts payable represents what we owe to vendors. We owe this vendor some money, and now we're paying off that vendor. So this is a credit balance. We're going to debit it to make it go down. Again, we might not know that. Like if we thought of the payable first, we may know that accounts payable is the account we need to do something with, but we may not be as clear as to whether we need to debit or credit it as we are with cash, which we're usually pretty clear on what we do with cash because we deal with cash a lot. So that's why it's easy to do the cash first and then say, okay, that means we must be debiting accounts payable. Does that make sense? Well, accounts payable has a credit balance because it's a liability. That's the normal balance. We need to make the bad thing go down because we're paying it off. Therefore, it's going to go down. So we're going to do the opposite thing to it, which is a debit. So that makes sense. Now we're going to post this to the general ledger. So we're going to look for the cash account and the accounts payable on the GL. So if we look at the general ledger, here's the cash account. Our first account is going to be in the same order as it was on the trial balance. Here's the accounts payable account on the general ledger. We're going to zoom in on those two accounts and record this transaction. So here's our transaction, debit accounts payable, credit cash. The accounts payable is debited $5,000. Here's the GL for accounts payable. It had $16,000 in it. We didn't pay off the entire $16,000. We only paid off $5,000. This is a debit. It's a credit balance. So the $16,000 is going down by the debit because we're doing the opposite thing to it as its normal balance, bringing it down to $11,000. The cash, again, is where the most activity is at. We can see all this activity in cash in relation to other accounts. We credit it $5,000. It's a debit balance account. So when we credit it, we're going to put the credit here, bringing the $31,000 down by $5,000 to $26,000. Now we're going to use this $11,000 at accounts payable and $26,000 in cash to construct or adjust our trial balance. So here's our trial balance being constructed from the GL. The things that changed are the $26,000. It's coming from cash. Again, yours is probably here. You don't have to repeat the $26,000, but $26,000 is being used to create cash. And then the accounts payables, the 11. And again, you're probably using this number You don't need to repeat it, but here's the 11,000 there. The rest of the accounts are being constructed from the GL as well, but they haven't changed. They've all been the same since the prior transaction. These are the two that have changed. Once we change them, then we can see if we're in balance again, adding debits, 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 minus credits, 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 which should add up to 0, and that's going to be an indication that we are indeed in balance. So if we think about what has happened here, we've got the cash decreased, so we have a decrease in assets, and then the accounts payable decreased. So the accounts payable went down, and that's because we paid off the accounts payable. The debit brought accounts payable down. That makes sense because we paid cash, which is an asset. We didn't get anything new. All we did was pay off something that we owe. Liability went down. There's no effect on the income statement because we paid something, we paid cash, but we didn't consume anything yet. We paid something that we bought, that we purchased sometime in the past. So note that this supplies account, it didn't get expensed at the point when we paid it on account. We paid it and increased accounts payable. We didn't even pay cash. We didn't expense it when we actually paid the cash because we paid the cash and decreased the payable. When is it going to be expensed? When we consume it at the end of the time period. So when we actually use it, when we count it and use it, that's when we're going to decrease the supplies, record the related expense at, that'll be an adjusting entry that we will do. So we got here that cash went down, assets went down, liabilities went down. No effect then on all of equity, including the income statement and net income. For more accounting information and accounting courses, visit our website at accountinginstruction.info.